Hello guys, welcome back with me. Don't forget to like, comment, share, and subscribe. While there may be a dark history of stock market crashes during the month, overall the month of October has been good. History shows over the last 21 years, the entire month of October has been a solid month for the market. Ranking has taken 3 for DJIA, S&P 500, and Nasdaq the Almanac notes. October has been a turbulent month, a bear killer, if you will, the Almanac notes. 12 post WII bear markets have ended in October of this year's were medium-term bottom. Stock tumble, dollar soars, and bonds plunge as recession fears grow. US and European stock tumbled on Friday. The dollar scaled a 22-year hike and bonds held off again as fears grow that a central bank prescriptions of raising interest rates to tame inflation will drag major economies into recessions. The Dow narrowly missed, confirming a bear market as a deepening downturn in business activity across the Eurozone, and U.S. business activity contracting for a third straight month in September left Wall Street wallowing in a sea of red. The British currency and the prices weakened further after the UK government announced it hugged debt finance tax cuts that will boost borrowing, sending UK bond yields valuing higher in their biggest daily increase in decades. The euro plummeted to a 20-year low and sterling to a 37-year low, while the dollar soared after the Federal Reserve's this week signal rates would be higher for longer. George Goncalves, head of U.S. Marcos strategy of MUFG, said the Fed wanted financial conditions to tighten and hike interest rates were the mechanism to deliver a market investor had not seen for a long time. It's something we're not used to, that's why it's more surprising for most, he said. It's going to be a long starring contest between the Fed and markets, and in the middle, in the economy which is not responding yet to this tightening. MSCI World Stock Index showed 2% to almost 2 years lows. The Pan-European Stocks 600 index closed down 2%, its biggest weekly loss in 3 months. On Wall Street, the Dow Jones Industrial Average fell 62%. The first major U.S. stock index to fall below is June struck on an intraday basis, but the blue chips index overtraded, confirming a bear market as it missed closing 20% or more lower than its record hike. According to widely used definition, the S&P 500 and the Nasdaq Composite, already in bear market territory, fell 72% and 1% respectively. Britain, Sweden, Switzerland, Norway, and other countries also hiked this week, but the Fed signaled that it expects high U.S. rates to persist throughout 2023, sparked drought in equity and bond markets. Investors are trying to get a handle on inflation and how high rates will go, said Andres Kiba, head of the Blue Bay U.S. fixed income team at RBC Global Asset Management. There's is in the market about having confidence that we know how inflation will develop and that yields will indeed peak in the mid-high 4, he said, referring to a Fed projection of the Fed funds rate at 4% in late 2023. People have been reflecting on that uncertainty, and it might mean more tightening ahead. It might mean even more tightening of financial conditions that markets have to go through. The euro fell for a foreign strategy day, sliding 1% to after that showed a downturn in the German economy worsened in September. There rose 6%. The Japanese yen weakened to 1,000 per dollar, but failed to notch its first weekly gain in more than a month. And Thursday, Japanese authorities intervened to support the currency for the first time since 1998. UK bond price went in total spin, with yields on the 5-year get leaping 51 basis points to 4,000%, the largest one there since outlets left. According to revenue data, after government's unilateral tech cuts, bonds price moves counter to its yields. Sterling fell in its biggest single-day decline since March 2020 when the COVID-19 pandemic rocked markets. The pound was already under pressure before the tax cut announcement on 11% since the start of July. Maybe that's all from me. Don't forget to like, comment, share, and subscribe. Thank you.